Good morning and welcome to Inside India. I'm JP Ong, and here are your headlines. President Trump claims he's gotten assurances from Prime Minister Narendra Modi that India will stop buying Russian oil as Washington and New Delhi resume trade talks this week. Gold prices going from strength to strength, with the precious metal soaring past $4,200 to hit a fresh high. And the earnings parade rolls on in India. More than a dozen companies reporting today, including IT majors Infosys and Wipro. Good morning, and as always, we take a look at how Asian markets are trending this Thursday morning as a quasi setup that is for the Indian markets is open in just a little bit. And we are seeing that overall it is steady she goes for many of these major equity indices. A notable shakiness that is, for the Hang Seng in Hong Kong, which is now reverted into the red, but not by much, down by less than 0.1% actually in today's session. The Straits Times Index also trading a third of a percent lower. Slight profit take, it seems, hitting Singaporean markets so far, but across other major markets, we are seeing that gains are looking quite solid and stable. The Nikkei 225 now trading about 0.9% in the green. The South Korean Kospi also up by about 1.9% on optimism that trade talks between the United States and South Korea will yield a positive outcome. Shanghai Composite in mainland China also looking quite steady today, up by 0.4% despite renewed trade tensions between China and the United States. And as we mentioned, the Indian markets will come online in about 45 minutes and take a look at where Gift Nifty futures are now pointing and whether or not they are looking at more gains. Yep, it seems that optimism reigns supreme once again for Indian markets, and they are trading, at least Nifty futures, about 150 points above Wednesday's close. And Wednesday was when Indian markets and the Nifty broke out of its two-day losing streak, actually, and rising by about 0.7%. But perhaps the story of Wednesday really was the strength of the Indian rupee, which went from 88.70 to 88.07. And we are seeing, though, that there is some renewed strength once again for the Indian rupee, now at 87.71. It's now fallen below that 88 against the greenback handle. And it seems that there are some better times, or flexing times, that is, for the local currency out in India. The U.S. once again is expressing its unhappiness with China and its new rare earth export controls. President Trump is telling the press that the U.S. is in a trade war with China and defending its use of tariffs for national security.
Mr. President, you're meeting with President Xi in a few weeks.
Yeah.
If you can't come to an agreement or a deal at that meeting, are we in for a sustained trade war with China?
Well, you're in one now. Look, we have 100% tariff. If we didn't have tariffs, we would be exposed as being a nothing. We would have no defense. You know, they've used tariffs on us, but we've never had anybody sitting in that chair that felt the need to do it. And they've allowed us to be $37 trillion in debt, et cetera, et cetera. Tariffs are a very important tool for our defense, for our national security. If we don't have tariffs, we're not going to have national security.
You also heard from Treasury Secretary Scott Bessent, who is also telling CNBC that the Trump administration will set price floors across several industries to combat market manipulation by China. Bessent argued that China has driven foreign competitors out of the rare earths industry by using its dominance to cut prices. Here's part of what he said.
So when you are facing a non-market economy like China, then you have to exercise industrial policy. So on rare earths, for 20 years, anytime, rare earths are not rare. What is rare is the processing and refining.
Which China dominates.
Which China dominates. I think they have 70% of the mining, but 95% of the processing and refining. And for 20 years, anytime anyone in a market-based economy stood up a processor or refiner, China came in, cut price, and put them out of business. So we're going to set price floors and the forward buying to make sure that this doesn't happen again. And we're going to do it across a range of industries.
I was going to say, though, where do you stop? I mean, pharmaceuticals are really important for national security. Defense companies, we have the Pfizer CEO, we have the Northrop Grumman CEO. Are you going to be taking stakes in all of them?
I don't think we have to do that. I do think our defense companies are woefully behind in terms of deliveries. So we may have to, as their biggest customer, may have to prod them to do a little more research, do a little few stock buybacks.
Remember that last week, China announced new restrictions on rare earths. In response, President Trump threatened to hit Beijing with with another set of 100% tariffs. Besant also said the U.S. needs to set up a strategic mineral reserve and that J.P. Morgan is interested in helping to create it. Besant also confirmed that the U.S. is talking to India and other Asian countries as the Trump administration plans a trip to this part of the world.
I think we are about to finish up with Korea.
Oh, is that going well? 'Cause there was some question about the investment there.
Yeah, as I said, the devil's in the details, but we are ironing out the details. I think there'll be, again, good thing about IMF and World Bank Week brings a lot of people here, so we'll be talking about that. President had a very good meeting with Prime Minister Carney recently, so I think U.S.-Canada is back on track. I know that the Mexican team has been engaged, and India.
India is happening soon. Are we going to see more announcements on the trip to Asia later this month?
Yes. So very good chance that I will go out early, meet with my Chinese counterpart, the Vice Premier, Hu Feng, who I have great respect for. I will meet him before. So there are two conferences, ASEAN in Malaysia. We're going to do a visit. The President's going to do a visit to Japan, and then move to Korea for the APEC conference, where the leaders, as of right now, will meet.
So as you just heard, Washington is also talking to India, aiming to finalize a deal by the end of November. And ahead of that, Indian Trade Secretary Rajesh Agrawal said the country is willing to lift its purchases of U.S. oil to $15 billion from an average of $12 to $13 billion. President Trump also said that Prime Minister Narendra Modi has assured him India will indeed not continue buying Russian oil. Take a listen.
We have a great relationship. No, we were not happy with him buying oil from Russia, because that lets Russia continue on with this ridiculous war where they've lost 1.5 million people, by the way. Russia's lost 1.5 million people, soldiers mostly. This is a war that should have never started, but it's a war that Russia should have won in the first week, and they're going into the fourth year. And I want to see it stop. So I was not happy that India was buying oil. And he assured me today that they will not be buying oil from Russia. That's a big stop.
And as New Delhi and Washington resume their talks, the impact of tariffs is showing in export figures for the first full month of trade since those 50% duties were imposed. India's merchandise trade deficit widening to a 13-month high of $32 billion in September as gold and silver imports soar and exports to the United States drop. Commerce Ministry data shows exports to the U.S. fell to $5.4 billion from $6.9 billion in August, while imports from the U.S. rose to nearly $4 billion. Gold imports nearly doubled to $9.6 billion, fueling that gap. Since we're talking trade in India, we are going to be joined now by Mr. Ajay Srivastava, the founder of Global Trade Research Initiative. He's also a former WTO and FTA negotiator on behalf of India, to talk to us about what all of this will mean for India's own future trade trajectory with the United States. Ajay, thank you so much for joining us today. Let's start off with a premise that some are actually floating right now, that the escalation of trade tensions between the United States and China might actually be a positive for countries such as India. Do you agree with that particular premise? And if so, why or why not?
So I won't say positive, but it has influenced the events. I think the United States is really worried about the Chinese control, the recent actions on controlling the rare earth material supplies. So US was trying to develop alternate supply chains, alternate to China for rare earths and so many materials. But now I think they want to be serious and they want to work in that direction seriously. And that's how they would like to have early deals with countries like India and a few others.
Okay, is this just a matter of just India benefiting from having relatively lower tariffs than China right now? Because 50% versus 100%, is that just basically saying that, hey, I'm the cleaner shirt in this dirtier pile of laundry at the moment?
No, I don't want to feel happy about that. No deal with Trump with any country is final. We have seen Trump has imposed 30% tariff on China. Now it's 130 or more percent, and same could be India. We have seen that nothing is final. Deal may happen today with America, and tomorrow the figures may be entirely different. So I just want to take it as it comes.
Yeah, and I think this is the thing also, Ajay, really, because we've seen the United States in flip-flop, or at least their negotiation or their relations actually flip-flop over the course of the last year in multiple times. In April, we saw it hot with China. We started to see it warm up again, and then now it's back to the cold front. And we've seen that also happen with India. Given that, how much can we really read into the possibility of colder relations between the U.S. and China being positive for India, because this could very easily change in the matter of next couple of weeks or months?
So I think it was the U.S. which was acting as a superpower. Now China was responding in a milder way. Now China is responding in an equal way. And I think United States has started feeling the pinch. And United States was acting as a sole superpower. Now I think they have to recognize that China is an almost equal superpower and better than US industrial systems. And now I think after some clash in the next few months, there will be a plateau, there will be maybe an equilibrium when both the powers will settle on quieter terms. But before that, some everyday clashes, every week clashes are inevitable.
So again, this also puts in the light India's own relations with countries that might be seen as a bit more adversarial vis-a-vis the United States. Let's start off with China, actually, since we're talking about that. And, we've actually seen that there were signs or overtures of perhaps warmer relations between India and China in spite of the historical baggage that these two countries have. Do you think that we might actually see perhaps India perhaps veering more towards China actually as an option amidst all of this, these changes that we've seen so far in the last couple of months?
Yes, for the import of industrial goods, India is more dependent on China than on US or any other country of the world. We import about 30% of our industrial goods imports from China, and China tops the imports in electronics, organic chemicals, APIs, and many other sectors. So China, India, whatever our political problems are there, trade continues unabated. There are no restrictions on the trade. During even the peak political tensions between India and China, the trade continued to grow. And right now we have a deficit of $100 billion. We are working on how to cut that deficit, but there is no tension on the trade front, and trade is continuing. I think it will continue to grow.
Yeah, and that deficit, though, is that something that India will want to right with China? Because there is also that concern, Ajay, that if China gets shut out of the American markets, they'll have to find other places to divert their goods, which means more pressure on domestic producers in countries where they might start to export some of these cheaper goods, such as, say, India, for instance.
Many countries are worried on this count. Right now, we see that Chinese exports to US are declining, naturally so. But their exports to other countries, including to Europe, are increasing. And same is happening with India. But most of the MSMEs and even large companies are worried about the Chinese aggressive tactics in selling the wares. For example, EVs. Now, for automobiles, China controls 55% of the production of the world. And countries, naturally, many countries have automobile industry. They are worried about the aggressive pricing of China. I think if some equilibrium has to be reached where China is less aggressive, China will remain welcome in most of the countries, including India.
Okay, and can China and India perhaps keep business separate from politics? Because as you probably know better than myself, I mean, the history between China and India, especially the last 120 years, is a little bit more complicated given some of the issues they've had on the border.
We have border issues, but on trade issues, there has been no problem. Trade continues to grow. I see from 20 years back, trade has started growing, and it's growing. And it did not take a beating even during the political or military clashes in 2020 at Galwan Valley. Trade continues to grow because India needs most of the industrial goods supplied by China. And we hope China accepts more of Indian goods which are good in quality, and we are able to sell to US Japan, EU, but not to China. So we should be talking to China to accept more of our goods. So trade, there is no problem. India needs China more than China needs India in the trade front, and I see it will continue to grow.
Okay, let's talk about the other relation here that might be put under the spotlight, Ajay, and that is Russia and India, actually. And as the American President Donald Trump alluded to, he said that India might be ready to actually stop purchasing oil and energy products from Russia. Do you think this is possible, though, given that they've actually highlighted that the purchase of these discounted Russian oil has actually helped keep energy costs in India secure and controlled for the moment? I mean, how realistic is this actually for India to do?
So I don't agree with this assessment. If US wants to stop the Russian war, all they need to do is to stop the supplying of military and other armaments, or even cut the supplies of internet. The war will end within the same day. But talking about India fueling the Russian war, I don't think it's fair. China buys more oil from Russia, but Mr. Trump doesn't name China. Even Europe buys more of the oil and many other things from Russia. Mr. Trump doesn't name him. Even America buys many of the metals from China, from Russia, I'm sorry. But Mr. Trump never talks about those things. So India not buying Russian oil will have 2-3 problems. One, Mr. Trump in all his deals, trade deals so far, for example, with Europe or Japan, he's pressing these countries to stop buying Russian oil and replace it with the American energy supplies. For example, Europe has committed to buy more than $200 billion of energy from America every year for 3 years at least. But America, how they are going to supply, nobody's talking about this big thing. They already have a trade deficit of $60 billion in crude oil. They import more crude oil than they process and export. So nobody is noticing this point. I think the way America is pushing others to stop buying Russian oil, which has 10% of global oil supplies, I think we may soon lead to the energy crisis at the global level. We must address this question. This needs greater discussions on different forums.
Ajay, I want to end this interview with this question, actually, with regards to the U.S. and India, actually, and the red lines that India has outlined are rather clear. One of them actually in agriculture, because the U.S. wants to export more goods, and there's also the prospect of exporting genetically modified crops to India as well. How important is it for India to maintain the line, and will this be a detriment to actually getting to a trade deal with the United States if India holds firm to this particular line in the sand with regards to agriculture products and making sure GMOs do not come into India more than they are already?
So, for us, most of the basic agriculture like wheat, rice, and similar things, they are grown by 700 million people. And it's a matter of livelihood for them. It is not a trade issue for us. If we allow import of agriculture products, basic agriculture products from US or any other country, some year there will be subsidized imports when Indian farmers, they will be unable to sell their products and there will be famine-like conditions. We don't want half our population to be at the mercy of the international prices. So basic agriculture is a big no-no. GMO, we have taken a decision that's not good for India, like Europe has taken a decision, and I don't think India should relent on these things to please US. We have to respect our red lines. Within that, we should be open to eliminate tariffs on 95% of US goods to India. They are industrial goods, and if India eliminates the tariffs on 95% of their goods, you should be happy for that. But agriculture accounts for less than 5% of their exports to India. India should be allowed to keep agriculture as its red line.
Yeah, and balancing food security as well as trade relations will be something tricky also, and something that India will probably find as the challenge moving forward. Ajay Srivastava from Global Trade Research Initiative, thank you so much for joining us today to help us get more insights into the evolving complications with regards to U.S.-India trade relations. And meanwhile, Apple is also wading back into the U.S.-China trade and tech war. CEO Tim Cook telling Beijing he is going to boost investment in the country. Elaine Yu has the details with regards to this. And Elaine, very interesting and very important new turn of events regarding Apple, given how big an investor they are actually in China. Talk to us about what else you can share with regards to this big announcement from Apple CEO Tim Cook.
That's right. This is Tim Cook's second visit to China this year, and he met with the Ministry of IT and Industry, where he pledged Apple's commitment to increase investment and to enhance cooperation with Chinese partners. This is despite U.S.-China tensions, and of course, Apple also ramping up investments domestically in the U.S. And the ministry also was wooing Apple again, affirming China's, quote, super large market and complete industrial system, and also promised to make the business environment for foreign companies, including Apple, more favorable. Now, Apple hasn't released a statement about this meeting yet. Just goes to show perhaps the delicacy managing China-related optics. But this also cleared China's domestic release of the ultra-thin iPhone Air. Now that the Ministry of Industry has recently approved the commercial trials for eSIMs, which iPhone Air models only support. But adding to the strategic importance of this visit is Apple's new COO, Sabih Khan, also in China, his first trip in his new role this year, and he toured Apple's facilities and key suppliers in China, including AAC Technologies in Jiangsu, which has partnered with Apple for 17 years, and also Lens Technology, also in Jiangsu. And this tour really highlights China's continued importance in Apple's global supply chains, despite efforts to diversify, including to places like India, JP.
Yeah, very fascinating, and definitely Apple one to watch with regards to China, especially given how testy things have gotten between Washington, D.C. and Beijing. Elaine Yu, thank you so much for that very important update. And coming up, we'll also get you the latest from the IMF and the World Bank's annual meetings, including the RBI governor's comments on the currency's volatility. Stay tuned. You're watching Inside India. Welcome back to Inside India. We did talk about the Indian rupee's recent strength overnight, and let's take a look at where the local currency is now trending. And we're seeing that it's continuing to hold on at about 87.76, below that 88 to the greenback handle now. Traders say that the Reserve Bank of India intervened in the currency markets yesterday to curb the pressure on the rupee, and that helped the currency post its best one-day gain in nearly 4 months. Meantime, RBI Governor Sanjay Malhotra has reiterated the central bank does not target any specific level for the rupee. Speaking at an IMF and World Bank event, Malhotra said the RBI's priority is to ensure orderly movement of the currency and curb abnormal volatility. Malhotra also said the RBI aims to promote its central bank digital currency over stablecoins and cryptocurrencies. The central bank has recently launched a retail sandbox for CBDC as part of its ongoing pilot. And the IMF World Bank's annual spring meetings are currently underway in Washington, D.C. CNBC's Karen So is leading our coverage and spoke to a number of central bankers and finance officials on the ground.
The rewiring of economies around global trade is a major talking point here at the IMF World Bank annual meetings. Discussions have been had to form new alliances and create fresh opportunities, which means a busy bilateral schedule. Already policymakers are on watch for the full impact of tariffs. There are concerns that the strengthening euro and more Chinese goods could pose a threat to Europe.
Some increase of Chinese imports, quite significant, plus 10% in the last 4 months compared with last year, which is disinflationary, and this is trade diversion after the protectionist measures in the US. There is the exchange rate, and there are other technical factors. And on the upside, there are little risk, especially after the trade agreement with the US, because the EU did not retaliate.
So far, we have not seen any major or significant impact in terms of our trade figure, but it's also true that it's a bit soon to have a full extent of the impact of this increase in fragmentation and this increase in tariffs. We will be monitoring very closely for the next few quarters as well.
One visible change in a highly uncertain world is the amount of gold being accumulated by investors and central banks. Poland has been building up its reserves since 2016 and has more gold holdings than the ECB.
Our reserves are substantial, so they are way above around 250 billion US dollars, and we want them to be diversified. So we hold the reserves in US dollar, in euro, in British pound, Australian and Canadian dollar. And we want the reserves to be diversified, and we just think that gold, we've been buying gold for many years now, and it's definitely helping the investment in reserves.
The Polish central bank intends to keep adding to those gold reserves, saying it strengthens its position as a reliable country. Karen Cho at the IMF World Bank annual meetings in Washington, D.C.
Well, coming up, a host of earnings to look forward to in the Indian markets, with IT giant Infosys and the parent of quick commerce firm Zomato reporting later today. We'll discuss in detail after a short break. Stay tuned. And we are counting down to the market open in India, and this is how things are now shaping up. A final check of GIFT Nifty futures, and again, optimism reigns supreme with them foreshadowing perhaps a 130-point gain actually from Wednesday's close. And Wednesday, as we mentioned, was the day when they snapped out of a two-day losing streak. We'll see if that's the momentum continues upward for Indian equities. The rupee now starting to soften a little bit after we saw it actually fall below 88 against the US dollar on news that the central bank did intervene to curb some of the volatility around this currency, now at 87.84 against the greenback. Now it's the time of gold buying in India as festive shopping is currently in full swing. Prices of the precious metal have been on a mad rally this year, and many look to silver when they couldn't go for gold. But even silver seems to be slipping out of hands now. The shortage of the metal has forced many of the ETFs in India to halt their silver purchases. Here's what customers and shop owners are saying about this on the ground.
There is shortage of silver. We are not getting what we want. Even if I pay for an order today, I will have to wait for at least a month to get it.
We give them silver from our stock reserves. We cannot fulfill the complete order. For example, if they ask for 5 kg or 10 kg silver, we tell them to manage with 1 kg silver.
We were planning to buy a bigger silver coin, but we can afford to only buy the smaller coin at the current rate. Still, we are happy that we were able to at least buy something on this Pushya Nakshatra. The rates are too high. How will small and middle class people buy? It is too much. It is increasing by 10,000 rupees. This should not happen.
What we understand the rate increase is that the import of silver jewelry, which had stopped and which is restricted by the Indian government till March 2026, plays an important role in this scarcity of silver today. And when we go to see the London market, the London exchange also is scarce with silver. The silver has now shifted to, most of it because of tariffs has shifted to New York, and there is 39% of lease rates which are now in London. Central banks which want silver is now in scarcity when they go to the London LBA, London Bullion Exchange. And I feel that this scarcity after 25th of October, the rates will come a little bit parity.
Now let's move on from scarce silver to a slew of Q2 earnings from India set to roll out later this afternoon. Among those, though, to watch, tech giant Infosys expected to post a 10% year-on-year rise in net profit for the quarter, with revenue also growing about 10% according to estimates. Wipro, meanwhile, is likely to deliver a muted performance as margins stay tight due to upfront costs. On the consumer front, Nestle India is projected to report a modest 1% profit growth, with sales rising about 4%. Eternal, the parent company of Zomato, will also report today. Analysts expect a mixed set of results with solid top-line growth, but softer profitability. And Reliance Retail is forecast to maintain its steady growth momentum in the second quarter, supported by expanding operations and stable margins. India's central bank minutes showing rate cuts could be back on the table as inflation hits an 8-year low. The RBI's Monetary Policy Committee kept the repo rate steady at 5.5% in its October meeting after a full percentage point of cuts earlier this year. The RBI retained a neutral stance, but the minutes show that members pushed for a shift to an accommodative stance. Governor Sanjay Malhotra writes that a more benign inflation outlook opens up policy space to support growth. The RBI now sees inflation at 2.6% next year, down from 3.1%, while raising GDP growth forecasts to 6.8%. Still, panel members warn U.S. tariffs and global tensions could weigh on India's outlook. The next policy review is set for December. And India's automobile industry is reporting broad-based growth in September. Data from the Society of Indian Automobile Manufacturers shows total vehicle production rose 11% year-on-year to more than 3.7 million units. Domestic sales across categories increased nearly 6% to 2.5 million units, while exports surged 20% to about 560,000 units. Passenger vehicle sales in the domestic market, however, were flat at around 300,000 units. The GST cuts implemented from September 22 ahead of India's ongoing festive season are likely to reflect when the October report card comes out. And how might this actually play into Indian markets and perhaps color the outlook for Indian equities? Christina Woon is portfolio manager at Eastspring Investments, and she joins us now after coming back from a recent trip actually to India, also getting a first-hand account as to whether or not the hype is real or the growing optimism might actually be real, Christina. And thank you so much for joining us, as you mentioned a while ago. Let's get into that, because you just came back actually from a trip to India where you didn't have to rely on the reports. You actually could see things happen on the ground. Share with us some of your key takeaways that are perhaps informing your approach to the market now.
Sure. I would say that if we looked at how Indian markets traded this year, it was a relative underperformer relative to the rest of Asian markets. From my perspective, that seemed like a good opportunity, if you will, to be on the ground hunting for truffles. And I was fortunate enough to be at least there during the first week of the festive season, straight after the GST cuts were announced, and that gave me a good sense at least of the pulse that of what we're seeing on the ground. So that was really quite interesting. I would say that the setup that we've seen, I guess, given the weaker performance year to date and going into some positivity from the numbers out of the first few weeks of the festive season, hopefully would be a nice setup for a nice year end and into a much better 2026 as well. So there's some of the headlines that I saw when I was there.
Yeah, so consumption, I think everybody was trying to envision at least that the GST reforms was going to provide that booster and perhaps also a buffer against some of the trade headwinds that we're actually seeing. What did you see on the ground that might have actually either supported or perhaps challenged this assumption that the consumption in India, so important to the economy, has gotten this boost that has everybody buzzing?
You're absolutely right, JP. I would say that when it comes to consumption, while the headline sounds great, you've got stimulus coming in, we do have to take a relatively nuanced view to it. I mean, a really simple example would be, when we're talking to companies and they say, and for example, soap had a GST cut as well, but just because soap is cheaper doesn't mean I'm going to buy more soap. I might either save my money from that or spend it more on some discretionary item. So we've really got to think about how this stimulus comes through in the economy, and that was really quite a useful insight to get from talking to companies. The other aspect of that, I guess, when it comes to autos, which you've sort of just touched on headline-wise as well, from a foreign perspective, you would think, wow, that's a really easy trade, right? There's a big ticket item, you've got GST cuts that are quite substantial, you've got rate cuts as well to help on the financing front. But the way I would view that is, how do you marry expectations with the way share prices have run in the auto sector over the past month and a half, and then being able to talk to companies and bounce off ideas about how they see the festive season coming through, how they intend to think about pricing. That was really quite useful to get a sense of how to position as well.
Right. I think this goes back to something you also actually mentioned to us before we actually brought you on the show, is that you have to look beyond the headlines and beyond the themes actually defined, as you've coined it, truffle hunting in some ways. I mean, could you elaborate exactly on what that means, perhaps not just for consumption, but say for other sectors while you're trying to find these truffles, as you call them?
Sure. I'll touch a bit on the consumption before I go to a different sector, but a really simple example that I have for you is within autos, again, a great past month and a half since the GST cuts were announced, but if you didn't pick the right company within that, whether they play in the entry segment of autos or whether they are more premium, if you didn't pick the right company, you would have very diverse set of returns. You would have anything from 0 returns over the past month and a half to 30% returns. So it's really important to then look at a company level to see where that benefit comes through. And it's the same thing with other sectors as well. So again, if you're worried about geopolitical tensions, one of the themes we'd seen this year was buy domestic in India, find something that's insulated from trade tensions. You could have done that by looking at the telco sector, and within India you would have 3 names to play around with. Depending on which name you bought, you would have had very different fortunes as well. So you've really got to focus on whether the fundamentals marry up with the top-down rhetoric, and that's how you really are able to pick the winners within each sector, rather than just going from a top-down perspective.
Yeah, I think that's the thing that perhaps befuddles investors, because they can pick a sector, they can say, oh, this looks like it's going to be good, and they stop there actually, or perhaps buy an ETF that gets exposed to that actually. But again, when you go down and pick a stock, there is a possibility you get, I don't want to call it the dud, but perhaps the least shiny piece of jewelry actually in the drawer. How do you avoid doing that? Because a lot of investors will stop at just the sectoral overview that, oh, everything's going to be good here. What advice would you give investors who might be stuck when they get to the point of, okay, which one do I pick in this basket of stocks in this sector?
It's a really good question. I think going beyond the story that you hear is really important. So, for example, rather than just say, I'll buy anything within this sector, you have to speak to all the companies if you can, or at least a good enough set of them so that you're able to discern where the variance is in their strategy. Are they really going out the full bang, with a lot of capex? Could that stretch the balance sheet? Is there demand to even support that kind of capital outlay? Things like that we've really got to weigh up, because that could result in problems later on, right? If, let's say, a company has bet too much on future growth to come and you've invested too much into capacity, you'll have a utilization problem in the future, and that could stretch your balance sheet, that could stretch your earnings. So these are a couple of things that I think from a fundamental perspective, it's so important to marry what you see on the ground and what you see in numbers with that story.
So here's the thing. When you look at a company and you try to evaluate a company, everybody looks at the profit, the profit and loss, or the income statement. How much money you're making, did you grow your earnings and everything? But you're actually saying that the balance sheet might be as important, because depending on how much capex they actually extend to support a certain momentum or a certain theme, you'll have to evaluate also if they have the space to do that, and if there are risks to, say, leverage or whatever. Is that pretty much it? Is the looking at the balance sheet rather than the income statement actually going to be more important when you're trying to now get down to the granularity of, okay, which stock versus which?
Yeah, I think you've got to try to have at least a sense of all of that, actually, your income statement, your balance sheet, as well as your cash flow statement. I mean, the fun thing about India, if you will, is that people view that market as a growth market. So you're looking at headline growth all the time. You see which company gives you the strongest revenue growth. And I think that's where the pitfall is, because if you just stop there and you see, oh, there's a lot of growth coming through, and you don't make sure that that growth is sustainable, then the valuations may not be supported. So I think being able to put the whole piece together with not just top line growth, but with whether your balance sheet can support it, whether your cash flows are able to support that, that really makes a difference in making sure that you can invest sustainably in the long term within India.
Yeah, so let's go back to valuation, because this is what another aspect of the Indian markets everyone's talked about this year, because as you alluded, I don't think it's as bad as some people say. I mean, 7% is not so, is still better than nothing. But again, when you compare it to the previous 2 years, you've definitely seen Indian markets perhaps take a breather. Some say it's as simple as just that valuations just ran up too fast. Do you agree with that? And do you think that now perhaps the valuations have taken enough of that breather to give you the reason to come back in?
Sure. I mean, I think there would be two things there. If you looked at, the broader region over the past couple of years, you perhaps had a slower China, you had other pockets of Asia that were a bit harder. So flows-wise, India was actually a good place to be. You had a lot of the small and mid-caps also running quite well. You had the domestic flows also supporting the market. So over the past couple of years, I think that's what we saw. If you fast forward to this year, I mean, to your point, there are two things there, right? You've got the flows that perhaps are going back into China a little from a regional perspective, and the second part is valuations as well. Back to the point we discussed earlier about how growth needs to match these valuations. This year we've seen a bit of an earnings down cycle, or downgrade cycle, if you will. That will hit your valuations as well from an investor standpoint, because people get worried, is this the moment that things turn, or are things slowing right now? I mean, to your point, these are not low growth numbers. They're still higher. They're still higher than perhaps the region or developed markets, but slower than before. So that's where you see a bit of that valuation. My perspective is India has a long runway to go growth-wise. Many sectors within there that could be very good positioning-wise over the long term. And in a pullback, again, part of why I went to India as well is to look for hunt for truffles there. I didn't meet a single company that I currently own, and hoping to find more ideas and develop them over the next month or so.
So since we talked about earnings a while ago, it just occurred to me that, or I just remembered that a number of other portfolio managers and fund managers we've spoken to have actually talked about earnings, and perhaps there's going to be a recovery. The other thing that was highlighted by a number of them is that when you go into sectors, you'll see a bit of a dispersion. For instance, cement stocks doing quite well and going gangbusters, but infrastructure stocks, their earnings being quite stagnant at the moment. Do you think that there's this dispersion, if it is existing in India, will persist in the next earnings cycles? And is this supportive of what you meant by not making sure you know where to go into a sector when you're looking for fine truffles?
Yeah, I think that's spot on actually, because within the sector, and you touch on infrastructure as one as well. Within that space, I mean, sure, top down the rhetoric of a growing infrastructure in India is there, but where are these companies playing in? Are they playing in the metro railways? Are they playing, or is the growth coming from perhaps an order book that's outside of India, which is what we've seen across many of these infrastructure companies? And that's really important as well. So I think into this result season, depending on where these companies have positioned to play into perhaps a capex boom, that's where you will see fortunes differ as well. Again, I mean, some of these companies that have been able to grow their order books outside of India, where perhaps private capex has been a bit slower, you might see better numbers than some company that perhaps is a bit more leveraged to private capex in India. So I think these are a couple of nuances that are quite important in figuring out which companies will hold up better.
Okay, so a final question here, Christina. We were talking earlier on to Ajay Srivastava of the Global Trade Research Initiative, and there is this theme right now that's being bandied out that says that rising U.S.-China tensions might actually benefit India. Do you support that, and does that necessarily mean it's going to be good for Indian markets if that particular premise plays out?
Yeah, I think, again, as you might expect from me, I think it's a bit of a nuanced answer. We also can't forget that India very recently was also seeing tariffs that were higher than most people expected. I think with what we've seen overnight on Russia oil as well, in discussions around that, perhaps we are seeing some of that being worked out. But the difficulty that we have is China's also got a pretty strong domestic economy that's pulling a lot of investor interest. They've got that AI rhetoric as well. So I think that's what investors in India also have to weigh up. The benefit, again, I think would be if you focus on very specific sectors where they're perhaps outside of anything that could be compared with China, that's where you could see some of this benefit. So for example, EMS, people wanting to build up more manufacturing within India, that's actually a space where stocks have done really well as well, and that could be an area that could be beneficial in these trade tensions.
Very quickly here, Christina, I can't let you go without asking you this. How is this reshaping your portfolio's exposure to India? What was it like before the trip, and what's it going to look like after the trip?
Sure. So I went into this year actually underweight India. So that's been beneficial so far, and I think that's given me the ability to at least position better and come from narrow that underweight. Post India, because the data points were, albeit early, quite supportive. I do have a number of ideas that I think would be worth looking on, and these would be across sectors as well, with the top-down rhetoric being fairly positive, bottom-up, again, being selective. I think that's a pretty good setup into the year-end in 2026.
So 10% exposure to 12% exposure?
Slightly higher.
Okay, we'll leave it at that. We'll have to ask you that when you come back again. But Christina, thank you so much. It's been very insightful and also very informative to see your approach to Indian markets, and perhaps some of our viewers can also learn from that. Christina Woon from Eastspring Investments, thank you so much for all the time you've given us. And we'll be back in just a little bit, because away from India, an investor consortium including BlackRock, Microsoft, and NVIDIA is buying U.S.-based Aligned data centers in a $40 billion deal, aiming to secure critical computing capacity for artificial intelligence. Aligned operates nearly 80 facilities across the U.S. and Latin America, with over 5 gigawatts of operational and planned capacity. This acquisition marks the first major deal for the AI infrastructure partnership, which also counts Abu Dhabi-based fund MGX and Elon Musk's XAI among its backers. BlackRock CEO Larry Fink says the move supports the group's goal of delivering infrastructure to power the future of AI. Aligned will remain headquartered in Dallas, Texas, with the deal expected to close in the first half of 2026. This deal also comes amid a surge of AI-related investments, with tech giants including Microsoft, Meta, and Amazon projected to spend hundreds of billions this year on artificial intelligence infrastructure. Well, coming up, Indian markets have now joined the trading day, and we will look at some earnings out of Mumbai and some movers in the markets after a very short break. Don't go away. We're back in 2 minutes. Indian markets have now come online, and 6 minutes into the trade, it seems that Gift Nifty futures were correct. They are trading about 0.33% in the green now, 25,411 points. And as the Nifty 50 finds room to rise, the Indian rupee is now looking for room to flex by just a little bit against the US dollar at 87.76 against that greenback. Well, let's look at how shares of Infosys and Wipro are now trading ahead of their earnings report card today. And taking a look at that, it is looking a bit more somber, that is, with regards to Infosys and Wipro. We're seeing Infosys shares down by about 0.2%. Infosys is still expected, though, to post a 10% year-on-year rise in net profit for this quarter, with revenue also growing around 10%, this according to market estimates. In Wipro's case, meanwhile, they're likely to deliver a muted performance as margins stay tight due to upfront costs. A quick check also on shares of Axis Bank. This private lender reported a sharper than expected fall in quarterly profits, weighed down by lower trading income and higher provisions for potential bad loans. Net profit for the 3 months to September 30 fell 26% to about 51 billion rupees, and that missed analyst expectations. Trading income dropped 55% as government bond yields rose, while provisions jumped 61% year-on-year. The bank also set aside funds for discontinued crop loan products, which it expects to recover. Net interest margin narrowed to 3.73% from 3.8% last quarter, pressure coming from this year's rate cuts. Still, the bank says its retail and SME books remain resilient, with improvements in cards and personal loans. Meantime, bad loans also hurting HDB Financial Services. Quarterly profits dropped nearly 2% due to rising bad loans and higher provisions for potential losses. Net profit fell to about 5.8 billion rupees, even as assets under management and operating revenue rose nearly 13%. HDB Financial Services is a non-banking lender majority owned by HDFC Bank, which holds a 74% stake in this firm. Take a look at shares of HDB Financial. They are now about 1% in the red, down to just below 736 rupees per share. And France's CMA-CGM announcing its first ever order for Indian-built vessels, signaling a boost for the country's shipping infrastructure. The global container shipping giant signed a letter of intent for 6 LNG-powered ships to be built by Cochin Shipyard, with technical support from South Korea's HD Hyundai. Each vessel will carry 1,700 containers, with delivery scheduled between 2029 and 2031. CMA-CGM says India's growing shipbuilding capacity allows it to diversify beyond traditional suppliers in China and South Korea. India is also set to mark a sporting milestone. Ahmedabad has been recommended to host the 2030 Centenary Commonwealth Games. The Commonwealth Sport Executive Board says it will put the Gujarat city forward for approval at the General Assembly in Glasgow next month, after a 2-city race between Ahmedabad and Abuja, Nigeria. The 2030 edition will mark 100 years since the Games began in Hamilton, Canada. The move also gives fresh momentum to India's ambitious bid to host the 2036 Olympics. Ahmedabad would be India's second time hosting the Games after New Delhi in 2010, and that edition came with its own set of controversies around corruption and scams. And that's it on the show today, but tomorrow we will be bringing you an exclusive conversation with the Foreign Minister of Canada, Anita Anand. She's recently talked about her country's approach while resetting ties with India. We'll get you more on that tomorrow. Don't miss that conversation. But right now, that is all the time we have had today on Inside India. Keep watching CNBC, though, because Access Middle East is coming up just next. Have a good morning.